Indian bank P&Ls are about to undergo a dramatic change. The Reserve Bank wants banks to provide for bad loans before they actually default. Now, currently, when a borrower fails to pay 90 days past the due date, the loan is marked as an NPA and banks have to provide for it. RBI has now put out a discussion paper which requires banks to provide for loans before they default. That is, one, when stress begins to start showing, they delay for 60 days, etc. Two, on the basis of historical bad loans in certain categories, auto loans, home loans, what's the percentage? Third, on the basis of interest rate cycle and on macro causes, when growth is very low. These higher provisions are not happening immediately. The discussion paper is out. Based on the reactions to it, Reserve Bank will put out draft guidelines and then there will be final guidelines. The banks will get 1 year to develop models and then probably 5 years to smoothen what Reserve Bank calls the provision shock or the capital shock. But it is going to be a shock. And those of you who are buying bank stocks need to know that the low credit cost, high profit period that we are now in is going to be replaced by a higher credit cost, but for strengthening the balance sheet. It could affect EPS and valuation in the near term. To understand more, I have with me an eminent panel. SBI Chairman Dinesh Khara, former RBI Deputy Governor Mr. Mundra, banking expert formerly from Bain Mr. Vardhan, and CRISIL Director Krishnan Sitaraman. Gentlemen, thank you very much indeed for joining me. Mr. Vardhan, if you can, first simplify for our viewers what this expected credit loss means and whether they have to worry about EPS and valuation.
Yeah, so the way bad loan provisioning happens today, Lata, is after the event. After you recognize the loan as a bad loan, a bank starts providing for it. What the new regime will do is saying that, look, these NPAs, the loans don't turn bad overnight. There is a steady decline in the financial health of the borrower. And so as a bank, as you start realizing this decline in health, you should start providing for it. Let me use an analogy, Lata. If there is a patient who has a heart attack, the current regime is that the entire treatment begins after the person has suffered a heart attack. The new discussion paper says, look, every year as you check the health, the health of the patient, if there is a deterioration, which means the likelihood of a heart attack has increased, then you start providing for it already. That's the crucial difference. Now, to respond to your second question, there would be a significant one-time provisioning that banks will have to make. My very, very crude estimate, and I highlight the word very crude, it's liable to change, is that something of the order of 3% of the loan book of the bank. Loan book of the bank today is about 135 trillion rupees, 135 lakh crore. So something of the order of 4 lakh crore may have to be a one-time provisioning. It may not impact EPS directly because it seems that RBI is going to allow direct adjustment on the balance sheet and amortize this provisioning over a 5-year period. But that will be a one-time shock. In fact, the discussion paper calls it a capital shock. What it will do in the long run actually is, I don't think there will be a material change to the structural credit costs, which is the provisioning that you do annually after this new system has stabilized.
Mr. Khara, thank you for joining us, sir. The number that Harshvardhan put out, it is possible that 3% of the bank book, outstanding book of the banking system may have to be provided for because they're either restructured, show some stress, or because of interest rate cycles. 4 lakh crore is a big number, however well adjusted. Do you think that this is going to be the kind of numbers we have to look at?
Lata, the way I look at it is that, part of it is also coming from the existing provision coverage ratio, excess provision coverage ratio, which is there with the system. So if at all, the kind of mechanics which is involved in working out the ECL and how will it really affect different banks, it will be a function of, one, of course, the quality of the book. And if at all credit cost is already low, which also is a reflection of a good quality of the book, and that is why it is low. And if at all, the only thing is that yardsticks on which the performing or otherwise will be assessed will undergo a change. And also when it comes to standard assets also, there will be another requirement of 0 to 30 days and 30 days to 0 to 60 days also. and that's standard provisioning will also undergo a change. But I mean, our assessment is that when we looked at it, total provisions which are required would actually be, to my mind, as far as the banking system provision coverage ratio is concerned, it is much healthier as compared to what is expected as of now. Important point which is mentioned by Mr. Harshvardhan also is that there is a very clear trajectory available in terms of the time period. And the second important point is that it is a impact which will come in the year when it is implemented. But at the same time, the future variability of the EPS will certainly be stabilized. So I think to that extent, it will bring in more stability, and also I think now till in another 5 years' time, banks will have enough resilience to take care of this additional provisioning requirement.
Okay, no, absolutely. In fact, the Reserve Bank told me, the Reserve Bank, higher officials, that is exactly why they're doing, because banks are in a healthy position now. But what is your best estimate of when will be the first year of recognizing this expected credit loss? Will it be FY24? FY24 looks unlikely. Will it be FY25?
I think, yeah, maybe FY25, if at all it gets implemented, then FY25 would be the first year. But then provisioning would be required to be made. Additional provisioning would be required to be made in a 5-year time over that. So I think whatever additional provisioning is now being seen on our calculation, we feel that it is not going to have any impact on the banks like us.
Okay. Okay, I'll come back to that, because there is one report out from Macquarie which says probably public sector banks will be impacted more. But I'll come to that, sir. Mr. Mundra, you've chaired a bank, you're chairing a NBFC, and you were the regulator, the deputy governor. So, when NBFCs went through this, we didn't even realize that they had gone into expected credit loss. Are these rules way more strict, and so we should, as bank investors, sit up?
Thanks, Lata. No, there would be clear differences. Number one, the universe in which bank operate and universe in which NBFCs operate, and most of them would be monoline or dual line kind of entities. So I think that is a clear difference. Plus, if you look at the whole, discussion paper which is issued by RBI, see, NBFCs are purely, guided by largely what is provided in the accounting standard. But in case of banks, many, regulatory fiat would be coming into play. I heard keenly what Mr. Harshvardhan mentioned and what Mr. Khara mentioned. I would put it like this: it is a huge unknown, but it is inevitable. If you look at the discussion paper, one thing is very clear, that between the two global models which are available, IFRS and GAAP, RBI has decided to largely go with the IFRS. That is there. Now, see, in certain areas, what they have presently indicated is more conservative than even what IFRS is, suggesting.
Yes.
Like, if you look at it, whether, IFRS goes with the instrument level recognition, RBI is talking about the counterparty level recognition, which will be a huge difference if you look at the calculation. Similarly, the migration from stage 3 to stage 1, RBI is proposing it has to first go through the stage 2 and then it can happen. Similarly, there are discussion about the prudential floats, regulatory backstops. They are liberal also in one or two areas. Like if you say that IFRS talks about 30 days, RBI is talking about 60 days for the overdue recognition. So those kind of provisions are there. I think, and then certain discretions are provided in the framework, even internationally. Just to give one example, there is a discretion to the regulator that how you classify ECL in the general provision and specific provision. And that would have a bearing upon the capital, how you calculate the capital.
Krishnan, just very quickly, if you can react to this number. See, all SMA loans, that is loans which have not passed due over 60 days, have to be recognized as early stress and provided for. As Mr. Mundra said, if one instrument of a borrower is NPA, the borrower is NPA. So all his loans have to be provided. These are big. So, is this number 4 lakh crore likely increase in, stressed credit a good number? Is that the kind of provisioning we have to do?
Thanks, Lata. Good morning, everyone. See, in terms of the numbers, I think we are still a little early to have a fix on that. The number could vary from entity to entity. Yes, past track record of NPAs have been different for different banks. It will depend on that, but that's one input. We'll have to look into the asset mix, how much is secured, how much is unsecured, what's the extent of collateral which is there, what's the extent of recoverability, and also what is important is availability of structured data. So to build these ECL models, to develop them and validate them, it's very important to have accurate structured data, and that is something a number of banks may or may not be in a position to have. That said, I think banks which have a higher exposures towards MSME segment, microfinance segment, these could be entities where their provisioning requirement could be higher, and it also depends on the existing provisioning requirement. As we see the banking system today, the provisioning cover is at 75%, which is probably the highest I have seen in my 25 years of tracking the banking system. So today the banking system health is reasonably resilient. So we have high PCR levels, capital adequacy has gone up to around 12.5% is tier 1, CET1. The NPAs have come down to around 4.5%. We are seeing ROAs gone up above 1% in the last quarter. So all of them are pointing towards the banking system becoming resilient. So this is an important step to kind of assess the ECL and provide provisioning from a futuristic perspective rather than an incurred loss perspective. So I would put it that way. Yeah.
Okay, no, I'm coming back with more questions, but Mr. Khara, before I let you go, the one note that we have out there says, PSU banks, even if they have to provide for standard provisioning, will have more to provide for than, you have to provide even for SLR loans, SLR bonds. So PSU banks will have that, they will have more MSME loans, they will have more farm loans. So, which are standard on the book, but they are already showing stress, more SMA too. So do you think that when the number comes out in FY25, it could be more for PSU banks? You may have 5 years, but will the FY25 number be a shocking number?
I don't expect that to happen for the simple reason, as I mentioned, that since the provision coverage ratio of the PSU banks have also improved significantly in the past couple of years. So I think, and also since we'll have another year before we actually start, so it will further go up. So considering the kind of difference which is expected to come in, and also the fact that there will be 5 years time period available for recalibrating the requirements in terms of provision, I think the PSU's bank should be in a position to handle it fairly well. This is what my assessment is.
Okay, so you are confident that it is not going to be a huge shock even for public sector bank investors. We have to take a break, but lots more questions for my guests after this break.